Good morning, everyone, and welcome to our webinar, The Future of Care, Exploring Hybrid Long-Term Care Solutions with Derek Lape. This is Jordan, the Marketing Coordinator here at AIM. Today's webinar will be recorded and then later posted on our website. This does mean that all attendees will be automatically muted so that we get a quality recording. If you have any questions, go ahead and type them into the chat box and we'll try to answer them throughout the presentation. But if we're unable to get to all the questions, we'll have a member of our marketing team reach out to you individually to make sure you get that answered. Before we get started, we'd like to invite you to join us for our next webinar on Tuesday, December 3rd at 9 a.m. Pacific Time. Join AIM Lead Internal Wholesaler Don Erickson and One America Regional Account Director Jen Wagner for a discussion regarding tax advantages of non-qualified annuity transfers for long-term care planning and how to maximize living benefits and legacy planning utilizing the Pension Protection Act. And with that, I'll hand it over to Derek so that we can go ahead and get started. Take it away, Derek.
Thank you, Jordan, and thank you for everybody for being here. I know a lot of you guys are really busy this time of year with AEP, trying to squeeze in as many appointments as you can before we start kicking off the holidays next week. So thanks for being here. So as Jordan already covered a little bit today, obviously we're going to be going over hybrids, the future of care. It's kind of a term that's getting thrown around quite a bit right now with what's going on in the landscape as far as, traditional hybrids, traditional long-term care, standalone long-term care, whatever you want to call it, has kind of really been dropping off over the last few years as far as numbers of sales. You can see it in, whatever insurance magazines you're reading, any news going around. You've probably seen it in your own office. So a lot of people have been looking to kind of hybrids as the solution or the answer to filling, these declining sales. Not going to read all this. You guys can kind of look at some of it, but the general idea of what it's saying is sales for traditional long-term care have really been dropping. Since 2020, there was about 50,000, and that's down to about half in 2023. It's expected to drop again this year. Obviously, we're not done with the 2024 year. However, it's not looking as promising, right? So there's a nice kind of gradual trend down, unfortunately, when it comes to traditional long-term care. On top of that, things like sales at work sites back in 2020 were around 21%. 2023, they're all the way down to 8%. So a lot of what insurance agents have been doing, who've been in the business for a while, at least the last 4 or 5 years, if not longer, has drastically been changing, right? The landscape's not quite what it used to be for those whose main focus was traditional long-term care. With that, however, as we all know, there are tons and tons and tons of Americans, turning 65 or older every day, right? It just keeps getting more and more and more. We're getting pretty close to that peak with the baby boomer era, where eventually that's going to start to drop off. But right now, a lot of people are age 50 plus, 65 plus. When you're looking at 70% of people age 65 or older needing critical care services before they die, there's still a huge market out there, and there's still a huge need for some kind of long-term care product, right? Something that's going to help take care of these critical care scenarios so they don't completely lose all their money, make sure they're able to actually get care. So there's kind of this weird trend going on. Part of that, obviously, is the difficulty people have been running into when it faces traditional long-term care. One of the first factors that pops up is price, premiums, just to get into it. Another big factor is going to be, obviously, underwriting. So we all know it has gotten a lot stricter to get people through underwriting and actually get them placed with the policy. The other kind of factor here too is a lot of people have been scared off from traditional long-term care. They've seen the premiums go up on existing policies. They've seen people getting stuff canceled because they didn't want to get their premiums up, right? There's been a lot of news attention on what's going on. Now, having said that, the newer policies, and what I mean by that is about the last 10 years or so, that have been reworked by most of the big traditional, long-term care carriers hasn't had any increases. They've done a lot better job about kind of pricing correctly. But also with that, they've really become a lot more stringent on their underwriting process. So it's gotten harder to get people through. So once again, huge need for the products, but there's not too many options for a lot of people out there because a lot of people don't qualify, a lot of people can't afford it, whatever the case is. So that's kind of where this trend of looking at hybrids has come in, and we'll dive into a bit more exactly why. But first, I just kind of wanted to show you guys a side by side. This is just a general workup, right? As you can see, the benefits are roughly the same for what they're getting. One thing to note on the right side, which is the hybrid side for the life policy, it's for 72 months, not just for 36. So it is going to be a little bit longer, which accounts a little bit for some of that higher premium on there. I wouldn't fixate too much on the premium. As you can see, there's about a $3,000 difference annually with the hybrid being a bit more expensive. Having said that, there are cases where sometimes hybrids are roughly the same price as getting traditional, right? There's a lot of moving parts you can move around to fit a certain budget. So there's a lot we can kind of do with that. But basically, this is just a quick kind of overview. We're going to dive a little bit more into the details here in a second, but right, quick side-by-side comparison. So, right, what does all this mean, right? And when you're looking at it, it's pretty simple. There is still a huge need, like I said a few times. There is still a huge market for people who need some kind of protection when it comes to critical care later on in their life. Traditional LTC is still a great option, right? When it comes to dollar for benefit strictly towards critical care, there's not much out there that's going to beat it because that's literally what it's designed to protect people for, right? It's the solution for critical care. Having said that, there are a lot of people who may not like the premium. They may not like the fact that it's use it or lose it. They may not like that premiums can increase. They may not like putting all their eggs in one basket. They might have different goals for what they're trying to protect besides just critical care. That's where hybrids are really going to come in, right? So don't completely abandon traditional long-term care. It's still there. It's still a great product for the right fit. But for a lot of people, it may not be, the perfect fit. And that's where we're going to start jumping into, all these different options, what most people call hybrids. There's a lot of different options when it comes to hybrids. So we got this fun little chart here, graph, whatever you want to call it, down in the bottom left. Basically, traditional LTC is in the top left, right? That's going to give you the most critical care, kind of dollar for dollar, what it's protecting. And then on the bottom right, life insurance is going to be just life insurance, right? So these kind of exclude one or the other, right? When it comes to critical care, there's no life insurance. When it comes to life insurance, unless you add a rider or something, there's going to be no critical care, okay? So, and that does vary a little bit based off of what product it is and what carrier it is. A lot of people do still have some kind of critical cash worked in there, right? Standard into their policies. So saying there's not going to be any is a tiny bit misleading, but for the purposes here, if it's just true life insurance, right, we're just going to say it doesn't have any critical cash. So between all these spectrums are kind of what we're going to be talking about, right? So we're going to have these hybrids that are going to be a mixture of either life insurance or annuities that are going to be mixed in with the critical cash. Basically, it's just going to focus a bit more on the critical cash side as far as critical care, what the people are going to need versus just getting life insurance. And then as you kind of move over to the bottom right, you're going to be getting into things more like riders, different stuff like that, which can still be pretty effective depending on what your client's looking for. So with that, one place to always start is kind of those general questions that if you've been on any of my webinars, you've talked to me, is something I recommend all agents do, right? It's trying to figure out why the client's talking to you. Why do they feel like they need the product they're asking about, right? What are their actual goals? What are their concerns? You might have someone coming to you for, traditional long-term care, but maybe they're worried about life insurance. Maybe they're worried about different things. And it might make more sense to do some kind of hybrid than to get long-term care and a separate life policy, right? They may be worried about the use it or lose it. There could be a lot of things that they're worried about that would kill a sale, right? But if you're figuring out what their goals are, what they're trying to get from it, then you can kind of cater a solution to fit their needs. So here's a bunch of different options. There's more than this. It would have taken quite a few slides to fit everything. But it kind of gives you a quick breakdown of some different policies that are out there as far as hybrids, more on the life side, right? Not so much on the annuity side here. But looking at kind of what's going on, what's out there. As far as pricing, most policies are going to be in the same ballpark, right? Regardless of what carrier it's from. No one really wants to price themselves out of the market. When it comes to underwriting, you're going to see the underwriting is going to be very similar based off the product type, not necessarily just the carrier. And what I mean by that is a hybrid annuity is going to be similar underwriting to another hybrid annuity, regardless of the carrier, right? Versus if it's all Mutual of Omaha, it's going to have different underwriting for the different product types. So a lot of different options out there, a lot of different ways to make things fit, which makes it pretty easy. Um, Part of what I was mentioning on that underwriting and kind of how strict traditional has become, right? I'm sure you guys have dove into it a little bit, but there's literally an entire book, right, for a carrier on exclusions, what's accepted, height, weight, different things like that. They're usually around 50, 60 pages long of all the different conditions versus once you start getting into hybrids, it gets a lot less stringent. So one example of that here is the asset care for One America's hybrids. Still obviously a lot of things, right, that could exclude you, but when you're talking about one page versus 55 pages, a lot easier to get people through. A lot of the things are going to also be pretty big things, right? They're going to be things that are going to get you excluded from just about any type of policy anywhere, right? So it's going to be pretty hard to get through with any of those conditions on the left. One nice thing to note, besides the fact that the height weight guidelines are pretty friendly, is the bottom right, right? So things like heart attacks, strokes, different things like that, they're only looking for about 6 months, right? So if you're healthy and good and it's been more than 6 months, you can probably qualify, right? So that's a big kind of point when you're trying to get someone through, especially when we're talking about our main, market demographic of being mostly elderly clients, right? Most of the people looking into long-term care are kind of around that age where they're seeing the need that they're probably going to have to start using it at some point soon, maybe in the next 5, 10, 15 years. Or they may be younger and they've seen what's happened with family, friends, whatever the case is, right? But something that put that need kind of forefront in their mind. Um, the majority of the time, it's going to be because they're getting older, right? So they see that benefit there. Getting even less stringent when it comes to underwriting is going to be any kind of annuity hybrid. As you can see, that list gets even shorter, right? So these are great things to kind of go to as far as if you have a client who may not be in the best health, they do want some kind of long-term care, right? These are going to be good options for that. Another option as a last resort, depending on what state you're in, would be short-term care, but we're not going to talk about that here. Just wanted to let you know there are more options, right? As far as other reasons, right, like we talked about, people may want to just kind of expand on what they're really looking for. So when it comes to both of these products, there's going to be some different options as far as what they're going to help cover. By that I mean when you're looking at a life hybrid, and One America's is a really good option as far as being more of a true hybrid. They're going to be if we're looking at that graph I had up, right, instead of being kind of in the middle lower right where they're going to be more life focused, they're going to be quite honestly in the middle, maybe a little bit more towards the long term care side. They do a really great job of making it very long term care leaning with life insurance. So you're going to get a lot of that benefit of great, you know, care benefits for when they have to go in there to get it with great life. When people are looking at, what route to go, this is why it's kind of important to get those questions of what they're actually looking for and what's going to be, forefront in their mind. Trying to find out what some of their objections are or hesitations for long-term care as you're going through it. The traditional is going to help you point them in the right direction. A lot of times when it comes down to, right, getting a hybrid versus a traditional long-term care, the hybrid is going to be a little bit more expensive because you're getting two policies meshed together to create one, and it's covering two things versus traditional care is going to be covering just one of those things. Just like if you went out and got just life insurance, it's going to be cheaper than doing, the combined policy. The pluses, though, are going to be quite a few. So when it comes to these, that premium is going to be locked in, right, for the life of them. It's not going to go up. There's going to be different payment options depending on what you're looking at. And right now I'm talking more about the life side for the hybrid. It's going to be easier to get them through. It's not going to be use it or lose it, right? Whether they go get into a facility or home care or not, the money is going to go somewhere. If they don't use it, obviously to their beneficiary, right? But it's not going to just disappear. That is a sticking point for a lot of people. So it's kind of nice to have that as an option. And then when you're looking more the annuity side, right? This is going to be people who are going to want some kind of steady income. The plus side is it's giving you both an annuity and critical care meshed into one policy, right? It's helping address a lot of different concerns that your client's going to have. The downside is if you compare it to just an annuity, it's not going to build cash value the way just an annuity would because you're funding, right, critical care mixed into it. That's one thing a lot of people are going to see when they're looking at it, especially if they were looking at just annuities. So if that ever kind of comes up with one of your clients, you're going to want to look at what they would be paying if they go out and get just a traditional, right? And then whatever annuity they're looking at, whether it's through you or a different agent, how that actually grows. And then going to have to do some math, figure out, what they're actually saving, or maybe they're spending more doing it that way. So there's some different ways to kind of counter some objections there when they're looking at just an annuity and like, yeah, but look how much this grows compared to this. Well, yeah, but you're funding, right, long-term care. If you do these two separately, it's probably going to be not as great. There's a lot of pros. There are some cons when it comes to hybrids, right? So the first one is, as I talked about, we're meshing together basically two different policy types. We're taking a long-term care and we're taking either an annuity or a hybrid and putting them together. So basically what you're going to be putting in dollar for dollar, if your main concern is just critical care, probably better off going for traditional, right? Unless you can't qualify for it or whatever the case is. If you have people who are a little bit hesitant for a lot of those main reasons, which is a good percentage of people these days, which is part of the reason why, these hybrid policies have kind of overtaken the market, right? There's a lot more hybrid sales going on than there is traditional. And that trend just continues to keep separating, right? So more and more are going towards hybrids, less and less towards long-term care. So that's a good kind of point there. The other thing to note on these is long-term care, right, has been the bread and butter for a lot of agents for a long time, especially traditional. Part of that is because it does have a great tail when it comes to commissions, right? So it's going to be paying out a really good percentage towards the back end. Having said that, these are life policies, a lot of these, and then obviously the annuities pay differently. They pay similar to an annuity, right? But they're going to be giving you usually a bigger percentage depending on what type of policy and the carrier up front, right? So that first year is going to give you a bigger percentage. I'm not going to say that it evens out, but it is nice. And the plus side you have is, as you're seeing when it comes to the trend in the market, hybrids are a lot easier to sell. So in today's world in 2024, where you might sell, you know, 4 or 5 traditional long-term cares in a month, you could probably sell 10 to 20 hybrids, right? It's just a lot easier. So it's going to kind of help make up some of that commission on the back end. You just have to be more consistent and active with it. You have to keep selling it, right? But that's kind of some of the pros and cons there as far as the commissions. Something that falls on that bottom right, as far as if we're leaning more hybrids versus traditional care and what it's covering, that I like to talk about is going to be IULs. So this is going to be very dependent on the state you live in, whether or not you can add long-term care riders. There are certain states like California, right, where you can't, and it's going to be carrier dependent too. Every carrier has different kind of rules on what they allow. But for instance, mutual, which we have up here, if you were in California, you can't add the long-term care rider. You're just going to have to go off their critical cash benefit, right, which is still pretty good in a lot of cases, especially if you have someone whose main focus isn't necessarily on critical care, but it's something they do want to have in there, right? Um, so basically for this IUL, as you can see in the kind of middle right, right? So the premium outlay here is going to be $298.25. We got a 45-year-old male. Part of the reason I chose that age is a couple reasons. So I'm trying to illustrate a few different things here for you guys. So one of the things I'm trying to hit at is if you have a client, like I talked about, who's maybe their family, their friends, family, whatever the case is, has seen what someone with no critical care protection goes through, right? They might start looking earlier than the average person. Traditional might still be a decent fit, but a lot of times, unless you're doing like a 10 pay or something like that, going a hybrid route is probably going to be a bit better. So that's one thing to consider when you have age, right? The other thing for this is a lot of people right now, whether they're going traditional or whether they're going hybrid, $300 is pretty average for premium a month for what people are kind of expecting to pay. So that's one reason why this is where it is too. I did a $300,000 death benefit. I did put on the long-term care rider. So in that upper left, as you can see, what that allows for is the full death benefit could also be the maximum LTC rider limit, so $300,000, right? And they can get $6,000, per month, right? So a pretty healthy benefit. A lot of times when you're building these, most people are going to be between 5 to 7,000. Sometimes you'll go a bit higher. Sometimes you might go a little bit lower. That could be based off the fact if they do have some kind of critical care in place already. Maybe the premiums are just too high, right? Or maybe they want to max it out as far as getting the highest benefit they can. But this is pretty kind of middle of the pack average. It's kind of the benefits you'd be seeing if you were building a traditional, right? So pretty healthy benefit there. The bottom left, right? So this is going to be illustrating the cash value growing in there. There's 3 different columns. And this is kind of going to be an IUL talk. This is going to apply for IULs, whether you're adding long-term care on there or not, right? The far left column is going to be the guaranteed amount, which is going to be at 0%. The middle is going to be kind of this midpoint, right, of about 3.15% in this case, what it's growing at. And then the far right is obviously the non-guaranteed illustrated rate. Mutual and a lot of carriers these days are pretty good when it comes to illustrating. They put down basically, and in this case exactly, what they've been averaging on return for about the last 15 years or so. It'll say in the illustration exactly how many years, right? So that's what it's actually been growing at. They're not saying what it could grow at, anything like that. When you're presenting this to a client on that far left side, I'll usually kind of make it's a joke, but it's not really a joke, right? If we're ever as a country, right, paying out the minimum, this 0%, right, that means our economy is worst case scenario, right? They're going to have a lot more things to worry about than how their life insurance or annuities or any investments really were growing if we've been returning a 0% or -% when it comes to the market over more than 3 years, right? The dollar is going to be in shambles for the U.S. economy. So if that ever happens, there's going to be a lot more for them to worry about versus this, right? And that's probably never going to happen, right? If it does, we're going to be in really bad shape as a nation. The midpoint is exactly what it's called, right? It's the midpoint. Realistically, what I'll tell people is you're probably going to fall somewhere between that middle and the right. That right is what it's actually been growing at over the last 15, 20 years, whatever the case is, and you'll see it in the illustration. Um, for right now, that includes things like, you know, the recession, COVID, right? So we've had some pretty big downturns, but it's still been returning pretty good. I like to point out that obviously that's not a guarantee. I'm never going to say that, right? But it's a fairly safe bet that they're going to be somewhere around those two. In this case, depending on what the client really is looking for, I might or might not rebuild this a little bit differently. But it's just to kind of give you an illustration basically of some of the different areas this can meet, right? So even though it's just an IUL, right, and it would be a hybrid, as far as definition goes, we put a long-term care rider on there. They're getting a pretty healthy long-term care benefit that they can use, right? They're getting $300,000 in life insurance if something happens to them, and they're also building some cash value. So it's going to be a really nice, you know, I don't want to say cookie cutter solution, but it's going to be something that meets a lot of different areas. Something that's going to help take care of maybe they are worried about leaving some money behind to their spouse or kids or grandkids. Maybe they are worried about possibly needing critical care down the road. Maybe they do want something that's going to have some money in there that they're going to be able to use, right? And there's a lot of different ways you can build these. Part of the way you can do it is to really maximize that cash value growth. You can really make sure that you're pushing the LTC benefit. You can make sure you're getting a better death benefit, right? It's a way to get in there and meet a lot of different concerns and needs and give a lot of different solutions with one product. The other plus side is while this still is going to have underwriting, it's not going to be as stringent as what you're going to see for traditional long-term care. It's probably going to be a little bit more so than if you were to go with an annuity hybrid, right? As you saw, very, very limited things that they exclude on those. But this is going to give them a lot of options, right? And if they really wanted to, you can build these to be a little bit more annuity like, right? And by that I mean you're really going to accentuate the growth on the cash value. You can do things like a camera 7 pay to make sure they're really fully maxing out what they're putting in to still take advantage of tax benefits. It's going to be a good option for someone who's in that 40 to 50 age range. You could, depending on the carrier, right, go with just traditional and they could pay into it. If you were going to do that with someone who's a bit younger, I would definitely look at doing a 10 pay at most, just so you're decreasing the chances that they're going to get increases in their premiums later on, right? But this is a good way to go. Some of the kickback I get from a lot of agents when it comes to IULs is simply they know what they are, right? Everyone's heard of them. They understand them to an extent, but they don't really know how to fine tune everything. And that's a little bit worrisome, right? If you're ever going to be selling a product and you don't really know what's going on, I understand why you don't want to push it. So there's a few different options for that, right? One, we're obviously here to help with that. We can go through stuff, we can help you figure it out until you get to a point where you know what's going on and you're comfortable not only building it, but discussing it with whoever your clients are. Or we can simply kind of get the information from you and throw together some kind of proposal, right? That you have, walk you through it, why it's good, what some of the objections might be, et cetera, right? Kind of prep you for this. That's what we're here for. So make sure you use that. But as far as the complexity of these, right? One of the biggest pushbacks is a lot of people will say, well, the price isn't really locked in, it can go up. Usually when that happens, it's for one or two reasons, right? The main ones. It's going to be because someone went in there and took out too much cash, right? They borrowed too much. And like most things, if you borrow too much cash, you're going to have to pay it back or it's probably going to run out of force. That's true of most, amongst most things. So if you explain it to your client that way, yes, there's cash value in here. Yes, it's going to be growing. Yes, you can borrow it. Um, if you take out from it, that's just going to come off the death benefit, right? All these are true statements, right? But there's a caveat. If you go in there and you have a cash benefit of 65,000 and you borrow 60, you're probably going to have to start paying that back or else it's not going to have enough money in there to keep it in force because you're also funding the life insurance, right? It needs to have the premium paid. Um, so the simplest way to kind of fix that, right, is to say, if you're going to take money out, give me a call, right, and then talk to us or mutual or whoever and figure out if they take out this money, what's going to happen. The other biggest reason people might start getting a bill that says, hey, you need to start paying this now instead of what you were paying or else it's going to go out of force, is agents will choose the option minimum payment. Um, it's going to be in different spots depending on what carrier you're talking about. But whenever you're building Index Universal Life, it'll let you build it for different ways to fund it because they are very flexible as far as getting the payments. The minimum payment, I don't care what carrier it is, it's going to keep the policy in force for maybe 5 to 10 years, right? It is giving the absolute money in there to just keep it kind of limping along. Never, ever select minimum premium. That's just going to set you up for a lot of headaches down the road, right? There are a couple instances where it's not a horrible idea to do it. If you are curious about that, right? Give me a call or ask me when I reach out with questions, what questions you have. But in general, I would say just never select minimum premium, right? So if you do that and you tell your client to come kind of talk to you and check before they borrow however much money out of it, it's going to be pretty safe that it's going to stay in force. The other thing that I like to do is I really like to check the illustrations and how they show the money growing in that bottom left over there. And I'll do it on the pages after that page, right? This is just giving you every 5 years for a little while, but they'll actually give you a breakdown of every year. And I'll scroll down through. I don't care so much if the guaranteed, that far left column, runs out of money. But if the midpoint or the non-guaranteed runs out of money before, age 100, I'm going to rebuild it, right? Because there's a chance that, later on at whatever time that shows it, they may run out of money, right? And this is something I can walk you through. A lot of people here in the office can walk you through it, right? Because these are really becoming the kind of go-to as far as a lot of people looking for, right, getting some kind of critical care. As I showed you earlier, there's a lot of different options out there. Some of them are a bit more simple, right? When it comes to annuities, there's not too many moving parts. They're putting money in there. They get really easy underwriting. They're able to take some money out because it is an annuity, right? They have some critical care with it. Um, so there's that option. There's the more kind of true hybrids, which lean towards long-term care, like One America, where they have great benefits, right? Um, all those are going to have some flexibility in how you're able to build them and what you're able to do with them, but they're going to be a little bit more cookie cutter approach. There's not too much you can play with, right? They're going to be kind of set up for what they think the main kind of goals are, right? So One America, life and critical care, right? If you go with a annuity option, they're going to be trying to address annuities and critical care. Um, but when it comes to an IUL, especially in a state where you can do a long-term care rider, there is so much flexibility in different ways you can build it to meet specifically, right, what their needs are. There are other whole life hybrids out there, but they're going to be kind of very middle of the ground too. They're going to have some things you can play with, some things you can adjust. There's not going to be quite as much flexibility if you're trying to meet, you know, one of three different concerns the person has, right? There's not going to be as many options to play around with and tweak. And this is kind of just a general overview, right? Because getting into any one of these things too deep would take an hour by itself. So depending on what questions you have, right, feel free to ask me when I call back or give us a call, right? Because then we can start to get into those. There are some other webinars out there on our website that dive specifically into IULs or into long-term care or whatever the case is, a bit more in depth. But this was just to give the general idea, hey, we still have this huge need when it comes to critical care and helping out people, and it's getting bigger every day for, quite a while, right? Into the foreseeable future. But it's really hard to get people in traditional long-term care right now. So what options do we have, right? And these are going to be your options. These are going to be the different routes you can take, the different ways you can go, and try and make sure that everybody fits into somewhere that you're able to help them, that you're able to give them a solution. For me, I know I spend a lot of time on IULs here. They're not my absolute favorite. It's not something I'm going to go to every time. I do love them. They're fun. But for me, it's really finding out what the client's apprehensions are, what their needs, wants, goals, whatever you want to call them, and then tailoring a solution to that, right? It's a lot easier to close on that sale. It's a lot easier to take care of their needs, right? When you do it that way versus just having something stuck in your head. And part of that is why I spend a bit of time here on the IUL is because there is so much you can change around. There's so many different fun little things you can tweak and do. Okay. So with all that, right, when it comes down to it, if you're got a client in front of you who's looking for some kind of critical care, right, obviously run through the different questions, run through the different steps. But part of the reason why hybrids are exploding when it comes to sales and how many people are placing them is because of that flexibility, right? No matter what the budget is to an extent, no matter what goal they're trying to, find something to fit, no matter what, um, to an extent, their underwriting status is, right? There is going to be a hybrid option for them. So it takes someone who's coming to you possibly, maybe they don't know what they want, which makes it easier to place them. Or maybe they're coming to you because they want traditional and they're just not the best fit for it, right? This is going to give you an option to actually take care of the client, to get a sale instead of just losing them and watching them walk away because long-term care wasn't really what they needed or they don't qualify or whatever the case is. It's going to give you a lot more options and a lot more flexibility so you don't lose out on a sale, right? So you can better meet their needs. Um, as we kind of discussed a little bit, right, it does cover a lot of different things, and there's a lot of different policies, carriers out there, and it's just getting bigger and bigger and bigger. Whereas the traditional LCC market's getting smaller and smaller and smaller. Uh, So it's something to kind of take note of. And like I said, make sure you guys are utilizing us. If this is something that you're on here watching because you want to see what the options are, like I said, this is a high level kind of overview. Let's have a deeper talk. Let's get into it. Make sure you're comfortable with it and able to kind of close those sales instead of missing out on them. But with that, I just want to say thank you to everybody for being here. I will be reaching out because we did have quite a few questions, but they're a little bit more specific. So I'll address those when I give you guys a phone call. Or if you don't want to wait, just call in. If I'm on the phone, somebody else can help you. But thanks again for being here, and I hope everybody has a great day. Bye.